Today's podcast is going to offend somebody, so I apologise in advance. I've been told not to talk about politics or religion in my podcast, but this isn't going to be about politics, but it's about the proposed tax slug, a $200 billion tax slug that could impact you after the upcoming federal election. So today I'm going to have a chat with Ken Race, Director of Metropole Wealth Advisory, who's going to outline some of these. Because when he told me that amount, that number, it was unfathomable. It's a staggering amount. And in fact, it's been supported by Treasury, who suggests that over the next 10 years, there could well be additional taxes and burdens on hardworking Australians of actually not $200 billion, but $387 billion. That must affect our spending capacity and our economy. So, welcome to this week's episode of the Michael Yardney podcast, where I have a chat with Ken Race about the tax slug that has been proposed for you and for me.
Welcome to the Michael Yardney podcast, where each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted our leading expert in wealth creation. That's the fifth time he's won a similar award in the last 7 years.
Labor are proposing up to $200 billion worth of new taxes. When my business partner Ken Race told me that, I recognised it as a staggering amount, unfathomable. I really couldn't quantify what that meant. So with so many new taxes and policy changes that Labor are proposing if they win the election coming up real soon, they're probably going to make us the most taxed country in the world. Now, this is not meant to be a political podcast, but I think we've got to be aware of what's possible. And for that reason, I've got with me Ken Race, Director of Metropole Wealth Advisory, to let us peek behind the curtain to see what's going on. Welcome, Ken.
Thank you, Michael.
Now, many of these changes are difficult to understand. We all tend to know about the negative gearing and the capital gains tax, but the numbers, I don't know, they're so large they're almost meaningless unless they're explained. So maybe you can break them up. Over what period of time are we talking about $200 billion?
Yeah, they're certainly talking over 10 years, which is, the way governments normally talk when they talk about these big policies. But what I found is the numbers themselves are so staggering, they're so large, we're almost desensitized into, well, what does that actually mean for me? So what I'm tried to do, and hopefully successfully, is I've tried to put some context around the numbers that are being bandied around for the various tax policies that Labor's going to introduce. But as a starting point, $200 billion as a raw number, that is higher than the total income tax collected from individuals. It's actually more than double the amount of tax collected from companies. So given that even the company rates when they pay tax ends up coming down to an individual, that $200 billion, if we look at it on a year-by-year basis, that's almost $1,800 per family group. So every family unit will be impacted $1,800 a year when we add all those taxes. That's a huge amount of money.
Yes, it is. So if you look at that, it'll be an immediate drain on our economy and put pressure on It's just spending what people have got as disposable income, what they can spend in the shops. Now, we know the common ones, so let's just quickly remind ourselves of what they are before we get into some of the ones people didn't know. So the loss of negative gearing benefits, that's received a lot of publicity. And recently it's actually been revealed that Labor made quite a number of incorrect basic assumptions in formulating the potential benefits. They're not going to get anywhere near the benefit that they'd expected. But what else is there that's been forgotten about this?
Yeah, I think, and I don't like this term, when they talk about property investors, I mean, they're just ordinary, hardworking Australians in the main. Over 91% of investment properties are owned by people who only own one property, and their average earnings is $80,000 a year. So these aren't greedy investors. In the main, they're school teachers, policemen, firemen, nurses. They're the bulk of these 91% of people who own one property.
Which means that if they follow the guidelines that Labor is proposing and they only buy new or off-the-plan properties, they're going to suffer, because we know the track record of new and off-the-plan properties has been horrific, with recent statistics from CoreLogic showing that a vast number, more than half the people who sold up properties they purchased off the plan in the last 8 years made a loss or made no money at all. In other words, they lost a huge opportunity. So that's going to affect ordinary people saving. But in fact, what these people are doing is also providing public housing. Government, in other countries, right, the government would be doing. But what's the government doing about this?
Look, the government spends on public housing about $4.7 billion a year. That's the same amount that they spend on recreation and culture. So they're virtually spending hardly anything on public housing, and that number over the last 20 years has been on a downward spiral. And what the government is saying they want to do by getting rid of negative gearing is they're saying that they're going to save $3 billion a year. Now, again, that's a big number, and you think, wow, imagine if a government could save that, what they could do with it. But they forget to tell you that the investor spends $44 billion a year to own and maintain those investment properties. So a lot of that money is supporting the economy.
It's like other parts of the economy in Australia where the government and private sector work together. Private schools, private hospitals, public hospitals. Here, the government hasn't really been providing much public housing, and they have been depending upon people like you and me to do that. And as business people, as entrepreneurs, we're prepared to work hard, save up, take a risk, take a long-term commitment. And I guess we're just wanting a fair reward back for it.
That's it.
Most businesses do lose money in the early days. That's not an unusual business principle. You do it in the short term to accept it in the long term. So I guess I'm talking about the concept of negative gearing. It's not a property investment strategy. It's just a way that you fund things for a short period of time, Ken.
Correct. And the only reason the Tax Act gives you the benefit of the negative gearing is because you are going to eventually make a profit and pay back all that money plus a lot more. Because if you did not believe you were going to make a profit, then you'd be denied that just under the normal Taxation Act. The other thing is, if we keep on the track of this public housing, there's only 400,000 public houses in Australia. 400,000. And that compares to nearly 3 million investment properties. So 3 million properties are there for people to rent by the private sector, when only about 10% is produced and offered by the government. So if this policy scares away just 10% of the property investors, the government will have to double its investment in public housing. Where's it going to get the money to do that?
Where's it going to get the resources to do that? It can't get other things right, can it?
And, it's been estimated by quite a few different economists that the loss of this tax benefit will actually cost every property investor on average over $5,000 in cash flow. That has to have an impact on rent, and based on a $5,000 a year loss, that's $100 a week that we should expect residential rents to increase. So while this policy is meant to help the first home buyer, it's actually going to detract from them because they'll be spending more money on rent and therefore won't be able to save their deposits. And the total market is probably split 10% first home buyers and 90% others. So the government is taking a sledgehammer to 90% of hardworking Australians who have bought their own house, crucifying its market value to maybe help 10% of the people. Surely there's got to be a better way if that's what the government is trying to achieve.
Fully agree with you. Now, lots been said about negative gearing, lots been said about capital gains tax, but when you started to outline to me some of the other taxes, there's a couple I didn't really initially see the significance of. Electric cars. Now, we all recognise that fuels are going to have to be different in the future and that we are going to have, I guess, electric cars and driverless cars. But what's Labor wanting to achieve?
Yeah, they want 50% of all cars to be electric within 10 years. And, a bold statement, no costing, no hows, no nothing. But if we assume that is possible, what does that mean? Because not all cars can be electric. The farm vehicles, the long distance driving, the utes, the four-wheel drives, they are not suitable for electrification in any way given what we know about technology. So that means over 75% of passenger vehicles will have to be electric. That means nearly everyone will be forced to either have an electric car or have this new tax imposed. So there's a new tax that the Labor government is looking at to, if your exhaust pipe throws out more carbon than a certain amount, you will be taxed. And there is not one car today that can meet that standard. So that means on average, every car driver using petrol will have to pay this $2,000 a year tax. Every car, $2,000.
Just to make things clear, we understand the concept of climate change and we understand that if we don't explain behind this, we're going to offend some people because we do recognise the importance of this. We're just talking about, I think, the practicality. Isn't that right, Ken?
The practicality, the timing, and facing up to the fact that it is going to cost, but how much, which will actually help us drive either investment or extend the timetable, as opposed to a very rash decision that is going to have significant unintended consequences. So there are ways to do things as opposed to whether you do them or not.
Well, one of the unintended consequences, or maybe not, is the huge amount of tax, of excises that the government currently gets on petrol.
Yeah.
Isn't that one of the things that keeps the wheels of industry turning, Ken?
Correct. There's over 46 cents per litre of excise duty. So every time you go to your Bowser and pay your $1.30, $1.40, whatever it is, 46 cents is going to the government. And in total, the government collects about $11 billion a year in excise duties. So if there's a 50% reduction in petrol cars to electric, that means they won't collect $5.5 billion per year in taxes. And again, that equates to over $5,500 per household. So if they don't collect it, how are they going to pay for the roads, the black spots? Are we going to have higher insurance, higher registration? Is our electricity going to go up? Because that's a huge hole in the bucket.
So clearly, our running cost of our cars may go down, but we're going to pay for it in other ways. Now, again, we're not saying we shouldn't be working towards climate change. We're just saying, hey, let's look at what the implications are. So that's one of the other taxes. And there's the retiree tax. A lot of people are talking about the loss of cash back on franking credits. And most people are thinking, well, that doesn't really affect me. I'm not a retiree and I actually don't own shares in my own name. So why should I bother about that, Ken?
And I think that is the dishonesty of this policy, because it seeks to hide the truth. Everybody has super who is working. We're all paying our 9.5%. And the government is actively trying to have us increase the amount going into super. So the focus has been on a small portion of people in retirement stage that they won't receive this cash back. And before I sort of go on any further, just to explain what it's about, companies pay tax, but people own the company and they get a profit distribution via the number of shares they own. It's called a dividend. So effectively, the company has prepaid your personal tax on the proportion of profits you will get from that company. And because we don't know what everybody's individual tax rates are, the government has a 30% blanket across a company in relation to its taxes. So when you now get your proportion as a dividend, if your tax rate was higher, you actually then paid the top-up tax between the company rate and your rate. And if your tax rate was lower, then you got a refund. Exactly the same as when you get a refund off your PAYG. If you overpay your tax, you get a refund.
So just to make it clear, you own a portion of the company, whether it's National Australia Bank or Westpac or BHP, and therefore you get a portion of their profit, and rather than giving it to you straight, the government is taking some tax out first, giving you the rest, and you've either got to pay a bit more tax or a bit less tax, depending upon what your own personal situation is.
Exactly correct, Michael.
But now, if I've paid too much tax, I would in the past have been able to grab a bit of it back. But they're not going to allow you to do that.
No more. And if you've overpaid your tax, then that stays in the government coffers. It doesn't go back to you. But if you've paid under tax, they're still going to tax you. But the whole conversation has centred around retirees. But it affects every man, woman and child. I know that's a bold statement. But
children as well?
Yeah, because they live off the proceeds of their parents' income, their grandparents who buy them presents, the retirement income that will go to pay for holidays. So everybody will be impacted because there'll be less money in the hands of individuals. And that impacts people even if they're not in accumulation stage, in pension stage, which is where the focus has been. If you're in a super fund, and most of us are because we're paying our 9.5%, our super funds would have got back that cash overpayment because super funds only pay tax at 15%. So that means your super fund will have less cash coming back, which means it'll have less cash to invest, which means you will have less money in your super fund. And this will grow and grow over the 10, 15, 20 years until you retire. And then you'll finally see what the impact of this strategy tax grab has had. So we're actually not seeing it when we're in accumulation stage, which is the bulk of the population. But every year we will have less money in our super to be invested, which means we'll have less money in retirement to take our pensions. And that's been worked out again by many different economists. For people still in accumulation, so that means you're still working, that's going to impact everybody between $500 and $2,000. That's per year. So imagine what that adds up to after 10, 15, 20, 30 years. So we're all going to have significantly less in retirement because of this.
Now, along the way, if you are a higher income earner, they're suggesting that the rate of tax higher income earners are going to pay will be higher. And there's this thing called bracket creep, of course, that just with inflation, we tend to earn a little bit more too, Ken.
That's right. So bracket creep is really getting back what you lose by inflation. Because we all know that $1,000 today is worth more than $1,000 in 10 years' time. So when we all started work, we might have been earning a couple of $100 and thought that was a huge amount. But, fast forward 20 years, $200 a week isn't very much. But as our wages grow, we move into the next income tax bracket. So what the one party of government, the Conservative Party, wanted to do was to actually give you back the benefit of inflation, so you weren't worse off. And the ALP is looking at getting rid of that and, in fact, repealing some of the tax cuts that the government and the House of Reps and Senate have already passed. So there's huge impacts on everyday people. And when you take all those things into account, the current estimate of new taxes and imposts on the Australian economy is not 200 million, but 387 billion. Sorry, not 200 billion, but 387 billion. That's the same as an extra $35,000 per household. Now, that's got to have an impact on the economy.
In additional taxes. Now, again, this is difficult because when we decided, are we going to put this podcast to air or not, we didn't want it to sound like a political statement because people have got to make their own decisions about what they want for their life and for their country. And it's not just how much money you got in your pocket, it's what you're doing for the community and for the country as well. But it is fair to have a balanced view on this. And clearly tax is going to be one of the issues for this particular election coming up. We are already one of the highest taxed countries in the world when you take into account personal tax, Medicare levy. And then we always forget, because it's hidden, the GST we all pay. So everything, not everything, but most of the things you buy, maybe not fresh foods, most of the things you buy, you're paying tax 10% on that. Then as a property investor, we're paying land tax. But they're also talking about, now, I don't know if it's whispers, I don't know if it's fake news for an election coming up, introduction of inheritance tax, death tax. I'm going to have to pay to die.
Yeah, and I think picking up that we didn't want to make this a political statement, I think the 5-second grab on TV or the radio hides the truth. So I think people need to be informed of what these individual policies are and the cost. And if people agree with them, that's fine. I think the purpose or part of the reason for this podcast was to let people peek behind the curtain to see a little bit more detail that actually wasn't coming out in the political press. And in relation to this inheritance tax, we see that is an approved policy of both the Greens and the ACTU. And the ACTU effectively basically drives the Labor Party. So if it's already an approved policy of the ACTU, I'm saying, how long will it be before the political arm maybe takes on that additional tax? And if they do that, then maybe the family home is next as well. And again, if people accept that, that's fine. But let's expose the truth in a little bit more detail so people can actually make an informed decision and then make it appropriately.
Well, Ken, thank you for going and doing all the research and putting all those numbers together. And they're backed by Treasury, ABS, and other economists' statements. So it's not just you having come up with this. Having said that, thank you for making me aware of it. It's a little bit scary. When you added it all up, I saw your figures that the Labor proposed tax. Now, they haven't come into government yet, and they haven't gone through the government, House of Representatives and Senate. So not certain they're all going to come together, but you were suggesting 57 billion extra tax to retirees, 31 billion tax on property investors, 30 billion on businesses using trust. We didn't even mention that the trusts are going to be taxed, higher tax on superannuation, 5 billion extra from halving capital gains tax, 2 billion by limiting what you can spend on accounting and tax services, plus. Boy, are we in for some interesting times. Thank you for making me aware of this, Ken. Now, this is a good time to actually get some advice on how to look after your assets, protect your assets, set up the right structures legally. Boy, is it better than ever. And as a tax strategist, I know that's what you and your team specialize in. So if people want to understand what this means to them and just make sure that their strategies are right, their structures are right for growing, protecting and passing on their wealth, including estate planning, I suggest they have a look at metropolwealthadvisory.com.au and find out more a bit about your services, or ring 1300 Metropole. And the links to this will be in the show notes so that they can actually have a one-on-one appointment with you to understand what it means to them as a tax strategist. And then you're going to advise their people what to do next.
That's right. So anyone who needs a bit more info, how they fit into this picture, how they should actually start planning for the future, then, as Michael said, look up that website and make contact with us. Love to talk to you.
So thank you a lot. And I guess there's some interesting times ahead. Let's see what comes of it all.
That's for sure. Thank you, Michael.
Well, there was a wealth of information in that show, wasn't there? And if you got some benefit from it, why don't you let somebody else know about the Michael Yardney podcast? Just like I'm trying to help you become a more informed investor, business person, entrepreneur, I'd like you to pass the message on one way or another through social media, link, whatever. Tell somebody about the show and help build our audience, which is growing very well all around the world. Very impressed with the statistics we're getting, all the downloads, but the aim is to make more people informed. And if you want to get even more information, not just these 2 podcasts we do a week, go to propertyupdate.com.au and you're going to get a daily dose of commentary about money, property, finance, tax, success, business from the largest group of experts I could put together. I look forward to catching up with you again real soon for the next podcast. In the meantime, spend your time wisely.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from today's show, we'd really appreciate it if you would leave a review, and we'll read it out on a future show, and Michael will gift you one of his books as a way of saying thank you. Just go to michaelyardneypodcast.com/review and let us know what you think. If you don't already subscribe, head over to iTunes or your favourite Android app. You'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 30 minutes.